those of you who don't know me, my name is Myrna Baltazar, but I think we've already been properly introduced. And today, or for the Zoom, is just to get you guys familiar with just basic things that we look at as a lender. It's a really short PowerPoint. It's like 15 pages, but I think the first 5 or 4 are just like basic info. So I'm going to go ahead and get started. If you guys have any questions, please feel free to jump in and ask, because we're such a small group. And, just know that I'm always going to be happy to answer any of the questions that you guys may have, whether it's an email, text, or a phone call. I'll always try and help you guys out with any questions. No question is dumb. Just an introduction. What is a mortgage? Loan process, loan products, and contact info. And of course, I've been in the industry for, I think it's been 23 years now. I know I'm old. But you know what? I can't imagine doing anything else. And things are always changing, so it never feels like it's an old thing for me, like an old job that I've been doing over and over and over, because things are always changing, like guidelines and regulations that we have to stay on top of. So I can't imagine doing anything else. So what is a mortgage? This is real basic, but it's a secured loan. Your home is collateral, just like if you purchase a car and you have to get a loan out on it, your car is going to be that collateral. For us, it's the house. And we'll have a deed of trust and a promissory note that you sign so that we can continue to get you a mortgage and get you into that home. And what does a mortgage payment include? So it depends on what kind of loan you have. If you have a conventional loan, you're always going to include your taxes, your interest, your homeowner's insurance, and if you have any mortgage insurance. I'm sorry, that's on an FHA loan. If you have a conventional loan, those things are optional. You do not have to include your taxes and your homeowner's insurance, but you will have your principal and interest included in that payment. If it includes your mortgage insurance, it's always going to say that it's including a PII plus PMI. And PMI MIP is this. On a conventional loan, if you don't have 20% down, PMI stands for private mortgage insurance. So there's an extra, like a different company that will come in and insure your loan to us, the bank, and say, okay, they're only putting 10% down. So we want to make sure that you guys are covered as a lender, and we're going to offer this private mortgage insurance. But the buyer is the one that pays for that private mortgage insurance to cover us. And if you're doing a loan, it doesn't matter how much money you put down, you're always going to have to pay that mortgage insurance premium. So you can put 50% down and you're going to pay mortgage insurance. The only time that there's an exception or something changes on that is after 11 years. If you were to put 10% down, after 11 years, that mortgage insurance premium will fall off. And believe it or not, I've only seen that happen one time in my whole entire career. And it was only because my borrower sent me his statement and he was like, Myrna, look at this. My payment went down. I think they made a mistake and I don't want them to come back and charge me for it later. So I looked at it and I was like, oh, it's been 10 years. You're on your 11th year. And so they went ahead and removed your mortgage insurance premium. So I do see that it does happen. It's only happened one time for me. An escrow account. So an escrow account. Yeah.
How did it go away? Like, did the lender take it away, or or do we have to ask for them?
Okay, so if you're doing private mortgage insurance, and that would be on a conventional loan, there's a couple of different ways. Like this last couple of years, you guys saw that values continue to rise. And so if your value comes up, you can ask the investor, the lender, to remove it and just say, hey, I believe I have like 20% of equity in my home. Can you please remove the mortgage insurance? Or they can actually say, well, we're going to need an appraisal in order to remove it, just to confirm that you have this much of equity in your home, to remove that private mortgage insurance. Another thing they'll do is say you have to have this loan for at least 5 years, and then we'll go ahead and revisit it. One other thing I've seen them do is say, sure, let's go ahead and get an appraisal done to confirm the value of your property, and we'll go ahead and remove that. So don't leave it up to them. They say that they will remove it when you have 78% of loan to value, which means 22% of equity in your home. But don't count on them doing it, because why would they? I mean, they're not going to stay on top of it. They're supposed to, but they don't. So yeah, you would be the one to initiate it. And the way, not you, but the borrower. So the borrowers encourage them when you're closing on their loan that if they have any questions on how much their house is worth and you know that they're paying private mortgage insurance, um, encourage them to reach out to you so that you can tell them how much the value of their property has gone up so that we can see if that's an option for them. And I have seen them remove it just with a phone call saying, okay, let's see what the values are coming in at. And they use like an AVM system, which is an internal system that they can use to determine what the value of the property is. As far as a FHA loan, that one will not be removed. Again, I mean, if you didn't put 10% down, you're going to pay that mortgage insurance for 30 years if you stay in it. But so for us, our borrowers, they usually, if they have to start with an FHA loan, chances are they're going to refinance out of it to get into a conventional loan because now they have equity, they built their credit, their income is better, and so they can qualify for that conventional loan. Does that make sense? I
Or
hope
can
so.
they streamline the FHA?
Streamline it to refinance it?
Yeah, and to
They,
remove the MI.
no, not on an FHA.
No?
Even if they streamline, they're going to continue to pay.
Okay.
Yeah, as long as it's an FHA loan. The only exception is if you put 10% down and you had that loan for 10 years and you go into your 11th year, then it'll be removed automatically.
Does
So
streamline mean paying more every month?
no. So what a streamline means is if you have a loan, let's say you have an FHA loan right now and you have a 7%. And in the next 6 months, it dropped down to a 5%. And you're like, wait, I want to go ahead and refinance my loan, but I'm still going to get an FHA loan. So what we'll do, it's called a streamline loan, where we'll just take the same loan and say, we don't want to have to go through all of the qualifications and have to do all of the like income and all that. So we'll call it a streamline and they'll just drop it from the 7 to the 5%. It's still a new loan, but it's still called a streamline because you're not having to do as much as if you were doing a regular refinance where you're having to qualify for the loan all over again. That's a good question. Any other questions on that? Nope. Okay. So then also, in Hawaii, there's lots of homeowners association. That's not foreign to you all. Everybody knows there's homeowners associations when we're working with condos and townhomes and, even regular single family residents. So that is not included in your payment, but we do have to take that under consideration when we are qualifying your borrower. So when we're looking at a debt ratio, and that's going to come up in the next slide or so, and it's like 28%, or 36%, we're taking the homeowners association dues in account for that as well.